Assalamu alaikum. This is lecture 26 of Advanced Cost and Management Accounting. Today our topic is cost management. Cost management is something, it is a subject which I am sure everyone is familiar with, and everyone exercises cost management in one way or another. The idea is the costs that have been incurred. Whatever one does, many times cost is usually being incurred. In running households, cost is being incurred. When you step outside of the house and you go into markets, cost is being incurred. When you take your family and friends and you go out for entertainment or to visit, sometimes costs are being incurred in gifts, in buying, in purchasing, in traveling. Sitting on a car and traveling on the road, cost is being incurred. So everyone is probably going through some kind of exercise to manage costs. We can see an example of a household where the household lady of the house, when she goes to the market and she looks at prices, she knows that she has some kind of limitation on her budget, what she can spend and what she cannot spend. So she will look at the prices and then she will decide how much to purchase, what to purchase, keeping in view of her limitation of the household budget. So in a way, she is managing cost. So she is using her own ways, different ways of trying to manage and minimize costs, how she can improve usefulness and value of her budget to the family by providing her with the goods and services that are most useful. So similarly, in an organization, the head of the organization is trying to manage their costs. Of course, in the organization, the objective is to maximize profits. But they go through similar kind of cost management exercises, trying to contain and curtail cost and manage it to get best value. We are going to look at different ways in which costs can be managed and how especially organizations are managing their costs in order to try to bring them down. At times like these, where financial strains are being felt almost everywhere, organizations, households, individuals, all alike are trying to manage the costs and manage especially the increases in cost and increases in prices, which sometimes are hard to manage with increases in income. So on the one hand, limitations usually faced are income remains as it is or increases at a steady pace, whereas currently the costs are going up usually much higher than what incomes can be expected to. And these are, there are various causes that lead to this: inflation and various other conditions, economic environment, even a global economic environment will have impact on many things of costs which are going to impact the individual. Not least of which, I'm sure most people have experienced, is the cost of energy, the cost of electricity, the cost of gas, things like that. Industries as well as households are feeling the strain of this increase in costs, which sometimes is disproportional to the increase in incomes. Let's look at a slide. In some previous lectures, features of traditional management accounting and mechanisms used to control costs were described. The focus on comparing actual results with preset standard, usually budget, and taking remedial action. The emphasis is on cost containment rather than cost reduction. Up to now, we have said that planning and control is an important and a significant part of entire cost management process. And the methods we have looked at for control is basically the comparison between budget and actual. That is the traditional method. Compare budget versus actual, look at the differences, identify where there are departures, why in some cases costs may have gone beyond the budgets, and take remedial action to try to contain the cost. So we have said the focus primarily is on containing the cost rather than actual cost reduction. This traditional method, the focus here is we look at what is the budget and we look at what is the actual. And therefore, we try to somehow ensure that the actual stays within the budget. If that's the case, then we are basically doing an exercise of containing, cost containing, not necessarily reducing cost. Our focus can be to reduce cost, and therefore organizations are looking at various methods and different ways in which they can actually reduce costs, not only limit themselves to containing. Cost management focuses on cost reduction and continuous improvement rather than cost containment. Management techniques develop over time, new management processes and techniques come out, and organizations are able to identify and follow different techniques for managing cost. We are saying that basically the focus now should be on making improvements and reducing cost rather than trying to contain the cost within the budget. So this is going to be a separate exercise and a new type of an exercise where organizations will focus on things like continuous improvement, improvements, efficiencies, savings, loss reduction, those kind of things which are actually going to reduce cost rather than just contain them. Cost management consists of those actions that are taken by managers to reduce costs. Some of the actions are taken on the basis of information extracted from the accounting systems. Other actions are taken without the use of accounting information. They involve process improvements where such opportunities have been identified. So we are saying that managers, the actions and decisions that are taken by managers, those actions are considered as cost management exercises. We have to see what actions have been taken in order to limit and restrict and improve performance to reduce the cost. What is the source of information for the managers to achieve something like this? Well, very often the first thing they will do is to look at accounting information. Accounting information will provide details of costs incurred in the various activities and heads and departments and so forth. And that information is used to try to minimize cost and bring about efficiencies and improvements. But not only can this be done through the use of accounting information, sometimes activities can be planned in such a way that efficiencies are brought about in the operations, not necessarily related directly to accounting information. We will see how this can be done, and there are various techniques and new thinking and developments in this area, and people have now started to focus on methods, whether information is accounting or whether information is, you can say, physical and operation oriented and activity based. Ideally, the aim is to take action that will both reduce costs and enhance customer satisfaction. Really, the focus is on customer satisfaction. Companies regard the success of their products as being closely related to customer satisfaction. Hence, if you are going to be too ambitious about reducing costs and being efficient and making progress and improvements without bearing the customer in mind. It might be that you can reduce costs by reducing some qualities of the product, some functions that it is doing. If you reduce that, some other aspects which can be reduced, and the product is not really the same, and you are just focusing on reducing cost. This is the danger. Costs must not be reduced at the compromise of quality and compromise of customer satisfaction. So we are saying ideally the cost reduction exercise must be compared with and must be side by side with customer satisfaction exercises. And really the aim would be to continue to enhance customer satisfaction, but at the same time achieve cost reduction. This is the challenge, and this is management, and this is where skills and techniques need to be used to achieve something like this. We are going to talk about life cycle costing as one technique which has been developed and is used to reduce and examine cost in a different way. Life cycle costing estimates and accumulates costs over a product's entire life. Organizations have been trying to identify and look for different methods, different ways in which to manage, reduce, and improve costs and cost performances. Different types of exercises have been done, and one of the new thoughts being exercised and a new technique being used is the product life cycle costing. Life cycle costing, as was said in the slide, it is basically an estimate of the cost of the product over its entire life. Now, by the entire life of a product, just like the life of anything else, any other asset, all assets and products and all kinds of things have one definite limited life. So you take a product at the start, when it is introduced to the market, that is the launch of the product. At that stage, the product is the launching stage. If it becomes popular, then it becomes the growth stage, and then slowly decline will set in. There will be some competition and other products will be introduced, and so there will be a decline stage and the end of the product, and new products will be introduced and they will take over. These are very fast moving times, and we have many examples of things having finite, definite, in fact short product lives. One example would be the use of mobile phones. Technology, wherever technology is being affected in products, there the improvements and the movements are so fast that actually the product life has been reduced and becomes quite short. I'm sure we all experience this in our homes with even the children and others, where mobile phones are being introduced into the market at such a high rate with different functionalities, different improvements, and different types of functions, that the old ones very quickly phase out. Somehow, there was a time when the emphasis was on the products. The organizations would emphasize that they should build for products to last. I think that is probably something of the past, and probably not even a focus and not even a priority of many of the technology companies currently. Because there is such fast improvement, they probably do not expect their products to stay and be existing in the market for a very long period. So we refer to mobile phones. The mobile phones, let's say, of something like 5 years ago, are probably nowhere to be seen. Such is the improvement and rate of growth in these products. That you look at mobile phones 5 years ago, and you go into the market today and see even kids and university-going students, they would also be using phones and mobiles which are advanced and much more functional, many functions to them, and higher speeds and different things added to them, cameras and radios and whatnot. So you can see that, and emails, of course, nowadays emails are being added onto the mobile phones. So this from this you can get the idea that a product will have a life cycle. So there is a start and an end to the product. Similarly, with other similar kind of technology items such as televisions. There was a time when television was black and white. Well, that was a very long time ago. And then even with the new improved televisions, with the color televisions, there were these large boxes that were sitting in the rooms and occupying a lot of space. And those have now been replaced by the very slim, almost either attached or hanging on the wall. So this is how so those products that were there earlier, they are slowly fading away and do not exist and are going to end. So there is such a thing as a start and an end of the product. So what product life cycle costing is doing is trying to estimate the entire cost of the product for its whole life, from start to finish. You estimate the revenues as well as estimate the cost and try to match and see how viable and how profitable the product is going to be. Of course, the cost, when you look at across the life cycle, will include the cost that is incurred in the research stage, in the design stage, in the early stages before the launch. So there is pre-launch and there is post-launch cost involved. This product life cycle cost will, of course, include both. In the pre-launch, you have the research, you have the design, you have all the experimentations and the lab tests and market tests and things like that. All that cost, plus then you estimate how long this product is going to be sold for. What is an estimate of the total volume that is going to be sold over its life? That total volume, and with the estimated price, you can arrive at the total revenue that is likely to be earned from this product over its life. And then you estimate what costs are likely to be incurred. And then you can see whether the product is worthwhile, whether it is profitable or not, and whether the organization should go ahead and make that kind of expenditure. The pre-launch expenditure, I said, this will depend very much on the product and the nature of the product. You can see that sometimes there would be a product which will even require an entirely new building area. So you will need a new building area and you will need entirely new machinery for it, new processes. You perhaps might even need specialized and expert management staff, employees of all grades in order to process the new product. So this cost at the beginning, the pre-launch cost, can be really quite significant. Apart from the research, the even manufacturing cost can be a significant amount, including, as I said, all kinds of assets, machineries, processes, building areas, staff being hired, and so forth. So that all cost can be included, and when you are estimating what is going to be the likely sales and the likely revenue, then that has to be seen whether this cost is going to be justified. Of course, this is based on estimates, and no estimate is likely to be 100% accurate. So it is going to be, the final result will be something that the organization finds out once it has launched and it has gone into the market. But you can see now that management is increasingly taking focus of market research, taking account of information that is coming from the market. A lot of emphasis is being placed on what the consumers demand, what their trends are, what the likely chances are of success based on market research type of activity. So the presence of the market, the behavior of the market is becoming increasingly important for companies to gauge what products and which side to diversify and expand in. So the life cycle costing is therefore an exercise in trying to summarize and present a picture of the entire product over its life. The life, as I said, will vary according to the nature and type of product. The type of products that involve technology currently have usually a shorter life cycle because there is so much innovation and there is so much new products that are coming up. In fact, the life cycle costing is going to provide you with information on whether or not to go ahead with the product. This will determine whether profits earned from manufacturing will cover costs incurred in the pre- and post-manufacturing stages. Life cycle costing helps management to understand the cost consequences of developing a product. It helps identify areas in which cost reduction efforts are most likely to be effective. So we are saying that life cycle costing is also going to identify areas where the cost reduction can be effective. When you look at the product from start to end, completely in its totality, you have the revenues and the costs in front of you. Then that provides better information for analyzing and for identifying how to bring about efficiencies, bring about loss reductions, bring about cost reductions, and therefore how profitable the product can be. So the life cycle costing is a new process nowadays, and it is being looked at with the view to manage the cost and enhance the profitability of the organization. Most accounting systems report on a period-by-period basis, and product profits are not monitored over their life cycles. Product life cycle reporting involves tracing costs and revenues on a product-by-product basis over their life cycle. The thing which is new with product life cycle is that traditionally information, accounting information, etc. has been looked at on a period-by-period basis, and usually 1 year is the time frame over which the costs are being totaled and summarized. So that is the traditional basis, but that therefore is being changed now, and life cycle costing is looking at the entire period of the existence of the product. This is one of the main differences. We are looking at profit and loss and balance sheet and cash flow type of statements. All those statements are looking at costs for that period, for the specific period, and that can be a month and a quarter, and usually ends in a year. Therefore, this is giving you a new perspective, and it is giving the company an overall picture of the profitability and performance of the product, whether or not the decision to go ahead with the manufacture and whether or not to go ahead and launch in the market. This is helpful when you look at information on the life cycle basis. 3 stages of a product life cycle are planning and design stage, manufacturing stage, and service and abandonment stage. So as we have said, that the life cycle involves 3 stages, and we looked at it and spoke about this earlier. There is a planning stage and a design stage. So this is stage number 1, planning and design. So planning and design is a stage where the design and the planning and information relating to the materials and the labor and the place and the accommodation and the space required, energy requirements. Initial costs, I mentioned earlier, might require new machinery. It might require new staff even. There might be a need even to add utilities so that the new product would require the use of generators and the use of other energy sources, and so that can be quite extensive. So all that is the planning and the design stage, where you identify the costs related to assets and materials and what the product is going to do, the functions, and how added the functions can be, and what flexibility and other market-driven facets you add to your product. So the first stage is the planning and the design stage. Stage 2, we are saying, is the manufacturing stage. So this is again the cost incurring stage. The planning stage is purely cost incurring. The manufacturing stage is largely cost incurring stage. The process is put into manufacturing. The product, the material has been acquired, and the machineries and assets, whatever are needed, have been acquired. The research and design has all taken place, and the product is manufactured and launched into the market. Manufacturing stage is where it is introduced to the market and you start to sell, and here you start to see how close your estimates are to the actual performance of the product. Estimating cost is one thing, and estimating revenue is another. The estimate of revenue is based on your estimate of volume, the quantity of the product that you expect to sell. That is market-based, perhaps much more subjective than the information relating to cost, which can be estimated using current cost levels for the different materials and for the different requirements of the product. Anyway, both need to be estimated, and you have the manufacturing stage where the product is launched and it is introduced to the market, and you expect that it is going to grow. Usually there is a launch stage, and during the launch there is a growth period, and there comes a time, therefore, at the end of the growth period, where the sales are going to first of all taper off and perhaps in the end decline. So the last stage is going to be the service and abandonment stage. The service is where you need to make corrections, do the repair work, you need to go and do the maintenance and all that. That's the stage where you start to maintaining it and give warranties and things of that nature. And ultimately it get to a stage where you will abandon it, and then you start with something else and start with a new product. So these are the stages in the product life cycle, and this is how a cost can be looked at, and organizations try now to manage the cost on the life cycle basis rather than on the period by period basis. Target costing. We have looked at target costing as a mechanism for determining selling prices. As a cost management tool, target costing involves various stages, and we'll just talk about them in a little while. Again, target costing is something which, as a concept, it's easy to understand. There are many occasions in which targets are set and the targets need to be achieved. In its very simplest form, you can think of a dartboard. A dartboard is a target, and there the darts have to be thrown at the dartboard at the targets to achieve the maximum score. So a target is something that you set and you try to achieve as a score. Similarly, these days in one-day cricket matches, you have usually the side batting first will set a target, and the total score scored by the first side batting first, that will be regarded as a target for the the side betting second. And they will then carry out and have their plans of how to achieve their target. And they will need to have their own strategies, starting at the front, at the top end of the betting order, how they need to behave and what kind of score they need to achieve, and what will need to be done in the middle order, and what will need to be done in the lower orders, and how the score should be achieved if it's a 50-over match over the 50-over period. In the first few overs, 10 overs, and then the next 10 to 20 overs. And so this is what basically target setting and target achieving is about. So when we are talking about target costing, here we said our starting point is to set the target selling price. We have a target selling price, and then we are going to have a target margin, profit margin. So the selling price can be targeted using market information. Similar products selling in similar markets will have similar prices, driven by competition and driven by product availability in the market. That will be the selling price. You then try to set a profit target. And profit target will be based on the expectation of the owners of return on their investment. The owners are going to have in their minds some estimate of what return they expect from the investment, and so that will determine the margin, the profit margin to be used. So the selling price, the revenue, the profit margin, the resultant amount is your target cost. Now that target cost is just a target. And like all other targets, like we said, in the case of the dartboard or in the case of the cricket match, a strategy needs to be evolved in order to meet the target. So in this case, we have a cost target in front, and we compare that with an estimate of actual cost and whether or not that actual cost falls within the target cost. And if it doesn't, then you need a strategy, you need to develop plans, and you need some kind of a task force that sits and identifies ways and means of improving processes, of reducing cost, of finding efficiencies, different replacement of materials, other experimentation, research, design, all those things. And the idea is to achieve the target cost. Once the target cost is achieved, then the product can be launched and you can expect the profit. And it can also determine your decision to produce or not. Because if the target is not achieved, then the organization should not actually go into production of that product. As a cost management tool, target costing involves the following stages. Stage 1, determine the target price which customers will be prepared to pay for the product. That's the selling price. Stage 2, deduct a target profit margin to determine the cost. The target profit margin, we have said, will be based on the expectation of the owner's return on investment. That return on investment will determine what kind of a profit margin should be set. Stage 3, estimate actual cost of the product. And stage 4, if estimated actual cost exceeds target cost, investigate ways of driving down the actual cost. So there is going to be a big focus now on finding ways to drive down the cost in case the estimated cost is higher than the target cost. In a way, this helps coordination within the organization, because in order to reduce cost, the organization will need the input from various different departments in the organization. All the different functions, the research and design function, they will need to be introduced, because they will need to identify how the design can be changed, how the process and the manufacturing can be altered in order to reduce the cost. The production team will need to be involved, they will need to assess whether what is being designed can actually be achieved. So they will need to in fact provide the input on practicality of the design function. Can the design as set out be achieved on the available machinery and on the available asset network that they have? So the production will need to be involved. The finance team is also usually involved, because the finance is the team that provides the detail of cost information, and they can come up with and provide the details of accurate cost information of whatever changes that are being made. So the finance can verify whether what is being set out and what has been expected as a cost saving will actually be a cost saving, and it will actually result in the estimate of the cost, lowering the cost and reducing the cost. Similarly, the marketing and the sales function will need to be involved. They will need to see what kind of changes are being made in the design, and they will need to then assess how the market will respond to these changes. What kind of alterations have been made in the product? Have any functions been reduced which would be important to customers and therefore will affect the marketability of the product? So the marketing, the design, the research, production, finance all need to get together and all need to then find how best to achieve the target at the target cost, and how best to reduce the estimate of cost which exceeds the target. So this is also a good exercise for the organization, because they have a chance of bringing all the functions together, and they need to coordinate and all need to work together. The first stage requires market research to determine customer perceived value. This will be based on its differentiation value compared to competing products and the price of competing products. The target profit margin depends on planned return on investment. A major feature of target costing is that a team approach is adopted to achieve the target cost. Team members include designers, engineers, purchasing, manufacturing, marketing, and management accounting personnel. So in this exercise of all the functions coming together and trying to reduce cost and achieve a target cost, it is essential and important that the functionality of the product should be retained. Of course, this will also be determined by the market research and market information, what functions the marketing people feel that the consumers desire, what functions the consumers are prepared to pay for, and what are the functions which consumers are not prepared to pay for. So therefore, the target will be to eliminate and reduce those functions which are least likely to affect consumer satisfaction. In our example of the mobile, we said the mobile has now added a camera function. So many mobiles can include the camera function within the mobile. They can also record videos using the mobile, and it can also be used for emails and things like that. And then at the same time, there might be some functions with the camera which the marketing find is not necessarily appealing to the customer or the customer satisfaction, and those functions then can be eliminated. The functions will include the radio function, the messaging function. All these are popular functions. But if there are other functions which are considered that they will not be valued by customers, then those are the functions that need to be identified and eliminated, and the cost reduced on those aspects. To reduce cost and to reduce functionality, that of course is not the objective and not the aim, because that will affect the marketing and sales of the product. Another aspect of target costing, an important aspect, is that this exercise and this detailed information and consideration and teamwork is being carried out at the planning stage, at the planning and the design stage. That means it is a stage before it has gone into manufacturing, and that's the stage at which costs can be impacted. Any changes and cost cuts and design changes, they can be impacted and they can be made use of in the actual product. Because at a later stage, if you start to redesign, then you have already incurred many of the costs which are the pre-manufacturing type of costs. And I said that the pre-manufacturing costs can be as extensive as having to have new buildings and having to have new machinery and even new staff and things like that. So in order to ensure that that cost is not wasted and there is no cost incurred which would then not be fully used, and that product will not be properly, it will not incorporate those functions, then that's the stage, the planning stage, at which to reduce and cut that cost. So target costing gives you the opportunity to look at the cost in great detail and work to reduce costs at the start and the planning stage. This is therefore the advantage of using target costing. The aim during the product design process is to eliminate product functions that add a cost but which do not increase market price. In the processes, if we want to think of what kind of costs are going to not increase the market price, then what kind of function is not going to increase market price but just add to cost would be, for example, the movement of goods, the inspection of goods, those kind of things which are incurred and processed during the process, additional to just the processing itself. There are costs that are not going to reflect in any kind of consumer value. The major advantage of target costing is that it is deployed during the design and planning stage. This way, it can have a maximum effect in determining the level of locked-in costs. Locked-in costs are those costs which you are committed at the start. Before manufacturing, you are going to commit in case you need new machinery, if you need new staff members, or if you need to add energy source, so you're going to add generator. Those are the locked-in costs, and they are usually those costs incurred at the planning stage and before the manufacturing actually starts. If the target cost cannot be attained, the product should not be launched. Design teams should not be allowed to achieve target cost by eliminating desirable product functionality. So this is in fact quite important, that the costs which you are going to commit and the investment that is being made in new products are very often at the starting point, at the commitment stage, that investment can be significant. So it is useful, in fact important, therefore, to consider the detail of costs at this stage, at the stage of planning and design. So planning becomes a very essential part of an overall business activity. So the planning stage, therefore, in most activities, in most businesses, can perhaps be regarded as the most important stage. In fact, there is a theory among the Japanese that of the total time spent in the manufacturing stage, if that's 100, 80% of the time should be spent at the planning stage and 20% at the manufacturing stage. Because if the planning is so complete and so detailed, then the manufacturing should be easy and they just need to follow what has already been planned. But if things have been missed out at the planning stage, then manufacturing will start to have hiccups and manufacturing will start to have holdups and blockages, and therefore the manufacturing is going to result in additional costs and wastages and stoppages, things like that. So target costing is also another way in which focus is given to the planning stage. Tear-down analysis. Tear-down analysis, also known as reverse engineering, involves examining a competitor's product to identify opportunities for improvement and or cost reduction. Another technique that is used in cost management is the tear-down approach analysis or the reverse engineering. It is commonly known that the manufacturers in Gujranwala, for example, are well known for their reverse engineering. Whatever product is given to them, they can open it up, see how it's made, and then make an exact duplicate and present it to you. So the reverse engineering is basically looking at one product, dismantling and examining what processes have gone in, how it has been made, and then coming up with the product itself. This is dismantling exercise, this opening exercise, this provides the opportunity to try to identify improvements in your own process. It allows you to see how other manufacturers are performing different processes. So it is going to be an example of trying to see where the competition is and how well you are in your practices, how good you are, and how you can use the experience of others to improve your own process and to improve your own products. So as I said, this is a technique which I believe is followed very well in certain manufacturers' workshops. The competitor's product is dismantled to identify its functionality and design. This provides insight about the process and the cost. The aim is to benchmark provisional product design with the design of competitors. So tear-down analysis provides an opportunity to benchmark. This benchmarking is another concept that we will cover, and this essentially is to examine competition, to examine the processes that are followed, and identify competitors' products, and identify what processes can be carried out and where improvements and efficiencies can be brought in to your own processes. It is an opportunity to try to make your costs low, try to make your products more valuable and more satisfactory, and try to improve your own marketing and your other efforts, and try to match what is being produced by the competitors so that you can also produce the same and be in a position to compete with the product in the market. That's all for this lecture. Thank you very much.